Hey, Sean, welcome back to the show. I appreciate you being here.
Lacey, thanks so much for having me today. Looking forward to the conversation.
Yes, I always love chatting with you. And I have to look. No, I did look. This is your third time on the MILMO show.
That's
Yes. So,
correct. Yeah.
yes.
So
So
the Three Timers
thank you.
Club. I'm excited.
Yes, I really do. I need to get a sticker or a button for that because there's not too many that are in the third timer club. I have to see if they're actually, Kate Horrell and Daniel Kopp might be like 4 and 5 club, but we'll see. I'll have to look that up. Well, I'm excited to have you on because you have a new book out, or I mean, it was out in September, with Cody Garrett called "Tax Planning to and Through Early Retirement," and that caught my eye because the military community, a lot of people do retire earlier than maybe some of their civilian counterparts, but some people are trying to intentionally in the fire movement retire early. So I wanted to know what is the difference between early retirement tax planning and just regular tax planning for retirement?
Great question, Lacey. I think the big difference is just the scope and scale of opportunities. So, what I mean by that is the tax code is very generous to early retirees vis a vis more conventional retirees. You have more bandwidth where you're not getting W 2 income, and that creates a lot of good planning opportunities. Now, I'll say this though. In today's environment, I would argue most Americans who are still working should be thinking to some degree about early retirement, not because they want to go to the beach at age 64. It's because, do you know if your job's going to exist 5 years from now, 10 years from now? It's sort of like the Hail Mary play in football. You have it in the playbook, even though you're not looking to use it. I feel like most Americans should at least have some accounting, some provisions in their tax planning for early retirement. And oh, by the way, if they're on the fence, the tax laws want you to retire early because it just opens up a really good door in terms of having low tax years in the beginning of an early retirement, in terms of potentially very tax advantageous Roth conversions, things like that. So that tends to be the big difference. But even though there is a difference, I think all Americans who are still working should be at least thinking about the possibility of an early retirement, whether it's wanted or unwanted.
Okay, I wanted to make sure I understood what you were saying there about the good years. Maybe is it you have more years that you won't have tax advantages because let's say you're not getting W-2 income, or is it on the other side, like if you retire early, you can get a lot done before you don't have those earning years? I didn't quite understand that part.
Great question, Lacey. So let's just picture the tax return of a very early retiree. Say somebody in their 50s, typically speaking, we could talk about military pensions and things like that. But for the more conventional early retiree in their 50s, just think about their tax return for a second if they do no planning, right? So no more W-2, and most Americans have no pension in their 50s. All right, so no W-2, no pension. So very little income's hitting the tax return that way. Maybe they have a small bank account. All right, now we got $1,000 or $3,000 of interest income. Okay, that's not too much. That's not so bad. And maybe to start off, they're living on a taxable asset portfolio. This is actually relatively common in the early retiree space. Part of the reason you get to an early retirement is you built up $750,000 in a brokerage account, $1.2 million in a brokerage account. Let's just say it's $1 million in a brokerage account. Now that's going to spit off some dividends, and you say, "Oh, that's no good. That's taxable." Well, perhaps it's invested mostly in domestic equities, in like an index fund, say. What's the current dividend yield on a broad-based U.S. domestic equity index fund today? As we speak in late November 2025, it's roughly 1.1, 1.2, 1.3%. That's the dividend yield. So that $1 million holding, let's just call it 1.3%. Do some math. Always dangerous on a podcast. My quick and dirty calculation is $1 million taxable portfolio in domestic equity index funds spits out, call it 13,000 of dividend income. And so that's not that much, by the way. That's a very small number for that amount of a holding. And oh, by the way, 90+% of that 13,000 is not ordinary income. It's qualified dividend income, which qualifies for the long-term capital gains rates, which, oh, by the way, are likely to be 0% for that early retiree in many cases. And all right, so that person then sells some of those the early retiree in their 50s sells some of that domestic equity index fund to fund their living expenses. So let's just say they sold 100,000 this year to fund their 100,000 of living expenses. Well, what's their taxable income on that? It's not 100,000, it's 100,000 less their basis. They may have invested 30,000, 40,000, 50,000, 60,000 in that 100,000 that they sold. So, getting to early retirement sets you up to have these years where your income is going to be artificially low, and it may be many of those years because you're living off that $1 million taxable portfolio. You've got the basis recovery. It doesn't spit out that much in a low yield world in terms of dividend income. So you could have year after year after year after year of zero or very low taxes in an early retirement. That's part of the reason I'm saying, right, wrong, or other, right? I didn't write the rules. The tax code loves early retirees, and if you can get to that early retirement, you might have many years like that where, yeah, you have a few dividends, a little interest income, and some capital gains, but if you can keep your income low enough, all of that might actually be zero taxed. You might even be able to do a Roth conversion on top of that and still be at 0% or maybe just 10% or 12% on some of that. So the rules really want you to retire early. And again, I'm not here to say those rules are good rules or bad rules. Those rules just are the rules.
Well, that's a really great segue to my next question. So, getting to be able to retire early, and I do not want to spoil the book, so people go out and buy it. But in the book, you talk about compelling three tactics
Yes.
and how they can help people save for retirement to get to the point where they can retire early. Can you kind of touch on what those are?
In the book, we talk about the compelling three for the accumulation years for your career. And those are, for most Americans, traditional 401k contributions, Roth IRA contributions, and then building up taxable accounts, taxable brokerage accounts. And let's just briefly go over each of those three. The most cost-effective way to build up tax-advantaged retirement account savings is a 401k or a TSP for those in the federal government. It's automatic. You get the deduction in your highest earning years. For most Americans, that's going to be the better play to pay less taxes when you pay the most taxes in your high earning years. So that could be very helpful, very impactful. Second thing is the Roth IRA. Well, you said traditional 401k at work or traditional TSP at work. Why are you saying Roth IRA at home? The way the rules work, most Americans of any affluence can't deduct traditional IRA contributions, but they can make a Roth IRA contribution, either an annual contribution or using a technique called the backdoor Roth IRA. And then the third one is the taxable accounts. Now, people worry about taxable accounts because, oh no, that's taxable income. Well, we already talked about basis recovery. We talked about a low yield world. Taxable accounts sit very well even in taxable solution today, and in early retirement can be the bridge from, okay, I have my earning years and then I have to live off something and then I can access my retirement accounts. The taxable accounts can be a great bridge and can go off at zero or very low federal income tax in retirement. So traditional 401k or TSP, Roth IRA, and then taxable accounts, those are the compelling three that we think work the best for most Americans. And we talk a little bit about in the book about things like the so-called mega backdoor Roth IRA, governmental 457Bs, HSAs. There are other things we could talk about later. We could even talk about military pensions if that's of interest. But, so there are other things that could be very worthy in this regard. But we say, if we're going to boil it down for most Americans, the compelling three tends to work out to build up a successful retirement.
Does having a military pension change how people should approach their tax planning? Because they're going to, and also disability in there. Many service members get disability in retirement in addition to their pension payment. So they for their lifetime have this guaranteed income.
Lacey, you raise a great point. And to be fair, I generally don't work with military clients, but I will say it does change the calculus 100%. And the military has these sort of interesting opportunities. Like, for example, if you're in a combat zone, you can have excluded combat zone pay. And, if you're going to translate that to the filter of our book, in our book, we talk about income disruption years. So there are Americans who get laid off. They go to grad school. They have these years during their accumulation years where artificially they show very low taxable income. This happened to me when I went to law school many moons ago. And that could be a time. Now, if you're in a combat zone, you're actually making W-2 income. That could be a time, throw that money into the Roth TSP, for example. Or it could be a time to maybe think about Roth conversions. You got to think about your spouse's income. You got to think about other income you might have. But, there could be those opportunities. Now, I will say this, though. People worry about taxes in retirement. And a big theme of the book is that taxes in retirement tend not to be as onerous as many Americans worry about. And we go through a lot of examples. So yes, having a military pension can create a different planning environment. But I will say this. It may be that the combination of a traditional TSP and a military pension still doesn't make it all that disadvantageous from a tax perspective in retirement. You got to do you got to do your own analysis. In these days, for newer service members, they're going to have decisions to make that could be quite challenging in that regard. So, Lacey, I will say that the traditional versus Roth in the TSP becomes more convoluted depending on the size of the military pension, depending on how long you're going to be in the military, right? So that's a very important question in that analysis. So I can't just give a uniform answer. Oh, you got a military pension, just do Roth TSP. I can't go there. But I will acknowledge it absolutely does change the planning. But I will say, even if you go the total inefficient way, you max out the military pension and you do traditional TSP, odds are you're still going to be pretty successful in retirement. And especially if you can get to an early retirement, it might be, maybe we do some Roth conversions between our retirement date and the day we turn age 65 and have to start taking our RMDs.
I know we've probably talked about this on previous episodes that you've been on. I'll be sure to link to all of those in the show notes for everybody. But can you touch on when you say conversion for people that have no idea what a Roth conversion is? Like, what is that? Who would need it? Like, do you have to have a traditional and a Roth, like at the basic level, if nobody's ever heard of it?
So a Roth conversion is a nice piece of optionality that our federal income tax rules allow. So recall there's traditional retirement accounts. So I take a deduction on the way in, generally speaking, but then it's taxable on the way out. Roth is the flip, right? So I contribute to a Roth and I don't get a tax deduction now, but it's tax-free on the way out. Well, the tax rules since the year 2010 have told us, okay, you're allowed, regardless of your income or other situation, to convert amounts that are in traditional retirement accounts to Roth accounts. And that creates optionality. That creates an ability. So we literally go into our brokerage account, or it could be into the TSP, I think is introducing this in 2026, where we can literally go into that account. We go into our traditional account and we say, hey, take 10,000, 20,000, 5,000, 100,000. Just, you pick the number. That's only limited by the portal itself, and that's generally not that limited. Pick whatever number you want to convert, and you say, all right, move this from the traditional account to the Roth account. Fully taxable. And what this does is it says to us, okay, we can essentially elect when to tax the amounts in those traditional retirement accounts, which is a very powerful option. A lot of option value there. Because say you're younger in the military, you're say 40 years old, and you put some money in the traditional TSP. Well, you're getting a deduction at whatever your marginal tax rate is now. That's great. But now between being age 40 and at age 75, that person's going to have to start taking it out, or a percentage of it. But essentially they have 35 years of optionality. They have 35 years at which basically during any time they can wake up one morning and say, hey, convert that amount or some of that amount to a Roth. And that optionality is so valuable because most Americans, including most service members, between age 40 and age 75 are going to have one or more years with very low income. It just happens. Even to affluent people, I've worked with clients where you look at their wealth on paper, you say that's high seven figures, maybe even low eight figures, but then you look at their tax return and you say this person looks poor. Well, all that means is their living is just not generating taxable income. In a low yield world, that's very possible. So that's why we like these Roth conversions. And you touched on a really interesting issue in the personal finance space. So what's happened is the availability of Roth conversions has become conflated with the necessity of Roth conversions. And look, I think vocabulary matters here. It's like going back to high school and the SATs, but boy, does vocabulary matter. Can Roth conversions be beneficial? Absolutely. 100%. We talk about some examples in the book where we think they're very beneficial. Are Roth conversions necessary? Almost certainly not. There's a couple of examples where you say, okay, that's about as close to a necessary Roth conversion as you can get. Rarely is a Roth conversion necessary. Can it be beneficial? Yes. Now, by the way, you got to work the numbers. It's not always going to be beneficial. But just because something is beneficial doesn't mean it's necessary, right? I've got the Italian coffee brew from Whole Foods in my pantry. If my wife takes that to work, and so now I have to go with the lesser quality coffee, that coffee could have been beneficial to me, but it wasn't necessary, right? The Italian coffee, not necessary. And I think that's where we are on the Roth conversion situation, where the personal finance space has gone too far on these Roth conversions. And what tends to happen is in retirement, one of two possibilities is going to play out. Either you're moderately financially successful or less in terms of success. And then you're probably not going to pay much tax at all in retirement, right? This is just the way the rules work. Or you're going to be very financially successful. And what's going to happen then is you're going to have some tax inefficiencies. And most Americans will gladly sign up for a highly financially successful retirement with some tax inefficiencies. We go through the numbers in the book. I've gone through the numbers on my YouTube channel. It's just hard to come up with a scenario where somebody is financially successful because they use traditional retirement accounts, but then the taxes come and now they're not financially successful. It's just not the way the rules work. Even the wildly successful people get the benefits of the lower tax brackets. And yes, maybe what's going to happen is one of the spouses dies. That opens up something called the widow's tax trap. And what that's going to mean is some of that RMD, some of the required distributions from those retirement accounts are going to hit the 32% bracket. I did an example recently, $3.68 million traditional IRA, 81-year-old widow. What happens is, in her example, it was something like 6% of the RMD is taxed at 32%. But she still has after-tax cash flow as an 81-year-old widow of $200,000. She's doing fine. And yes, the spreadsheet tells us there's this minor tax inefficiency there. There's also something called IRMA. It's a surcharge on Medicare. Yeah, it matters, but it's certainly, it's a 2 or 3% surtax at most. It's just not going to derail her finances. And so using these traditional retirement accounts, even if it's in conjunction with a military pension, tends to be a good play long-term for most Americans.
Thank you. I really appreciate that, because I do think that there is this, everybody needs a conversion, and that's not the case. And it's hard because there's benefits. Yes, a lot of people should be, especially military spouses, contributing to possibly a Roth IRA or just an IRA in general, saving for their retirement, because often they're not working or have this inconsistent employment. But then it's like this terminology that's talked about a lot, and now conversions getting thrown in there, and it's like, no, we're getting everything kind of mixed up here, and you might not need that.
Yeah, so let me give you two examples that I think a Roth conversion could be very beneficial. One is combat zone situations, where my understanding is, and you got to do your own research on this, is that you could have your combat zone W-2 income. Now, I understand it's still going to be subject to FICA, so you're still going to pay Social Security tax on that and Medicare tax, but it doesn't show up as taxable income. Well, if you're in your 30s or 40s and you spend a whole year in a combat zone and that's all your income. Maybe you have a little interest income from your bank account, or you got, a little bit of a brokerage, or maybe one or two rental properties, but the depreciation sort of negates most of the income. Well, okay, your income tax return artificially looks like, hey, I got almost no earnings this year. Well, that could be a year. It looks basically like an income disruption. It's like you're in grad school, but no, you're in a combat zone. So okay, you just don't show that much taxable income. Why not do a Roth conversion then? Use the standard deduction, maybe even the 10% bracket or 12% bracket, and you've now had this optionality where you elected to tax that in a year. You just happen to have very little taxable income, so that's one time. Another time might be early in a retirement, maybe in the middle or before RMDs, before Social Security, and you have no other income. You're living off some capital gains. That could be a time to do a Roth conversion. Those two times sort of say, okay, there could be these windows, but I don't, I see this like, oh, you should do Roth conversions through the 24% bracket. Well, okay, what are you avoiding by doing that? You're reducing your future RMDs, a legitimate planning objective, but it might have been that the RMD that you reduced, some of it would have been taxed at 24%, and some of it would have been taxed years later at 32%, and maybe not even that much of it. So it's like, well, you maybe made 8 cents on the dollar. Is that beneficial? Yes. Is that necessary? Almost certainly not.
Okay. No, that's good food for thought for people that weren't sure. I appreciate that. And I probably should have asked this question in the beginning, but what's the difference between lifetime tax planning versus annual, like filing your taxes? I know we've discussed this before, but I always think it's good to revisit because often people get those things confused.
Sure, Lacey. So annual tax planning is, what can I do to reduce this year's taxes? And by the way, like in theory, that means you should always just contribute to traditional retirement accounts and that's it. And I actually think you have to actually look to your lifetime taxation to make that decision. But annual tax planning can also be, hey, do I have an income disruption year? Do I want to max out on charitable giving this year? There could be these little one-off questions that can add some value to your planning. And, maybe 2025 is a high income year for you and 2026 is going to be a lower income year. So, Lacey, maybe you got like a big new client in the door in 2025 or some big bonus at work that's not going to be replicated in 2026. So maybe this is the year to do a big charitable gift before year end to take a big deduction versus next year when your income might be going lower or you might be taking a sabbatical next year or some such, right? So that's one thing to think about. Thinking about lifetime taxes is thinking about the different yous in a sense, right? The 30-year-old you, the 60-year-old you, the 90-year-old you. And I think what you're trying to do is sort of two things. One is to limit total lifetime taxation. And in the book we talk about pay tax when you pay less tax, which for most Americans tends to be retirement. But then the second thing is also limiting the impact of the taxes paid. So I'll just give you a quick example, right? You're a service member, you're 40 years old, you got 2 little ones at home and a wife. Well, okay, putting money in the TSP at that point in your life, if it's traditional, has this additional merit of saving on your income taxes to help support those 2 kids and the wife, right? At that moment in your life, unless you're a trust fund kid or something like that, those taxes are very impactful. But what about the taxes when you're 90 years old? So you or your spouse has survived to 90. One of you has died. One of you has survived. What's going to happen with those taxes at age 90 is they tend not to be all that impactful. Either you're only moderately financially successful, so they're very small taxes, or you're wildly financially successful, and those taxes just don't matter anymore. You pay them because who's going to the tropics for the first time at age 90, right? Nobody. So it's not like you have all these expenses. And oh, by the way, if you're now in long-term care and that's all your expenses, then in many cases, the way the medical expense deduction works, 92%, 92.5% of those expenses might be fully tax deductible anyway. So you don't care if it's coming from a traditional IRA. So annual versus lifetime is important. They both add value. They both matter. I would rather focus on the lifetime taxes, not the annual taxes, but you can walk and chew gum at the same time. And so you can have some good value add from both.
Because a lot of people say that you should pay, do more Roth in your, especially for young service members. And what I'm thinking is like, you're not making a lot right now, might as well give it to the Roth so then you don't have to pay taxes later. So you're saying like there's a lot of other factors that go into that decision.
That's right, Lacey. Now, look, you might have someone who just got their commission from West Point or Annapolis. And so, I don't know everything about pay structure, but, let's say that person was in college essentially for, 5 months, 6 months, and then they work for 6 months in, their first assignment. And okay, great. Their salary that year might be very low. Maybe that's a year for the Roth TSP. Absolutely, that could be a consideration. But I also think about like, all right, now they're 30 years old. So they're not crushing it. They're doing just, maybe they're making their way up through the military structure, but they're certainly not a 4-star general. And, now they got the wife and they got the 2 kids, and the taxes can be impactful at that point in their career in the military. So maybe that's a time to take a tax deduction. And, if it, essentially, who do we want to prioritize? Do we want to prioritize ourselves, our wife, and our 2 kids? Or, our 2 kids are 4 and 2, right? They can't go and earn an income. Or do we want to prioritize our affluent 85-year-old self who is doing just fine financially and might have some tax inefficiencies? Look, this is subjective, to be fair, but I would subjectively say I'd rather prioritize supporting the wife and the 2 kids and ourselves when we're 32 years old or 28 years old. And if that potentially sets up some inefficiencies later in life, I'm okay with it. And by the way, maybe I'll have years in my 60s and early 70s where I could do some low tax Roth conversions anyway, if I'm really worried about it. I've seen this. I saw a situation where people were talking to a single mom who hadn't built up much in the way of financial assets. And, and it was like a little kid at home. And they were saying they meant it so well. They meant, you should just contribute to the 401k at work to the employer match and then do the money in the Roth IRA. And I thought to myself, wait a minute. What are you planning for there? Right, by not putting even more money in the traditional 401k and instead shifting it to the Roth IRA, you're helping that woman when she's a affluent retiree. That woman who's a single mom and 35 years old and doesn't have much in the way of financial wealth needs to build up financial wealth and needs to keep her expenses low to help support their child. They don't need to do retirement tax planning. That's not their problem. The problem in their life is supporting their kid and building up some financial wealth. They ought to be focused on doing it as quickly and as cheaply as possible. And in that woman's case, it was traditional 401k. It was not Roth IRA, right? Why are you passing up a tax deduction? Look, if that woman had $3 million in a 401k already, okay, fine. Yeah, let's start doing some Roths. That's fine. But, most Americans, Lacey, I can send you a link to this if you're interested. UBS Bank, they do a global wealth report every year. And I have not back validated this thing, right? I mean, they're a huge bank. I'm going to trust directionally they're correct. Their global wealth report claims that median adult wealth in the United States in the year 2024 was just a whisker under $125,000. Okay. And that's median. So that's 50% more, 50% less. That's not average. That means at least half of American adults are not in a position to retire with good sufficiency. 125,000, and I get it's not age adjusted, so some of that's because there's 22-year-olds in there, and some of that's because there's 80-year-olds in there, and presumably the 80-year-olds are wealthier than the 22-year-olds. But still, I would argue the problem that most Americans have is not taxation in retirement, it's sufficiency in retirement. And Roth, as great as Roth is, and I'm not against Roth, but Roth governs for wealth, but it also governs for taxes in retirement. Well, if you're going into retirement with $250,000 financial wealth, you're not going to have tax problems in a retirement. If it's all in a traditional 401k, you're going to pay very light taxes. So I think Roth is great. And look, I think the Roth IRA for many affluent Americans, for successful service members, right, where they're, doing the TSP, they got the pension they're building up. Why not do that Roth IRA at home and just have this tax-free reserve of money? So I do think sometimes we over-focus on the issue of taxes in retirement when there are other issues, including our current living expenses and building up sufficient assets for retirement.
I'm really glad I asked the question earlier about the difference between your long-term tax planning versus planning to file your taxes. And a lot of people in our community, that is the issue that's most pressing to them. It's like, I need somebody to help me file my taxes. But that might not be somebody you establish a relationship with that is doing planning. They are for your taxes. They are just there to file your taxes. So there's a lot more that could be done. And you might get tidbits of that when they're helping you file your tax. But I think I'm guilty of this in the past, and I think a lot of people are, is like, we're not doing this proper planning at an earlier age or income level.
Yeah, so and you're touching on a great issue, which is tax return preparation is a challenging industry. And the big recommendation I have for folks there is working with their tax return preparer on extension. So people think like, oh, April 15th, I got to get that thing filed. Well, you do have to pay your liability by April 15th, but you don't actually have to get it filed. If you file an extension, you have 6 more months. And I actually think that's a really good path for a lot of Americans working with a paid preparer. Tax return filing season for most paid preparers is just grueling. You don't want to work with your tax return preparer in February and March and early April because they're under the gun. So I think most Americans would be well served by talking to their tax return preparer, in the fall and early winter and say, hey, could we do this on extension next year? You still have to do a little estimate with them, like make sure I got enough paid in, but you essentially work mostly with your tax return preparer in May, June, at a time they're a lot more well rested. Let's put it that way. But then you also touch on this really good point around there is a difference between preparation and planning, and you hear that folks say, well, my tax return preparer doesn't do any planning for me, and then you say, well, wait a minute, what did you pay him for? And by the way, the industry has some issues there. The industry has been slow to adopt a planning mentality. So that is another consideration. There are some tax return preparers that are more planning focused, but I think they are somewhat still rare, even in the year 2025, 2026. But Lacey, you bring up a really good point. There's a big difference between tax return prep and tax return planning. And you want to talk to your advisor, your return preparer beforehand to understand what it is they're going to do, how they're going to charge their fees. And then you might want to think about this little tactic that I like, which is filing on an extension when we're working with a paid preparer to help to get a better experience out of working with that person.
I love that. That's really great advice. And people sometimes are scared of taxes. Like, that's fearful for them. And so I understand why people kick that can down the road or don't want to establish a relationship. But I think a lot of things, just having your team on deck, it's like having the person you go to that cleans your teeth, your doctor, your, barber, your hairstylist, all these things. You get more comfortable the more you go and you get used to them. And it's just, instead of it being like once a year and it's just, hey, file these, maybe establishing a relationship. And I love the time frame. I want to ask one last question about this. If, for people that are 10 or 20 years out from retirement, I guess maybe we'll say 10, because I know that's a 10-year difference there. What is like the 2 most important decisions that they should be focusing on? Like maybe some first steps like that could help them in the long term.
Well, I'd say the first one is determining what retirement looks like. So what's the time frame on retirement? What are we going to be spending on retirement? And what asset level are we aiming for on retirement? So that would be the first thing, is like, before you do your tax planning, you have to sort of think about like, what does your retirement, at least in broad strokes, look like? Not that all right, I'm going to retire at age 53, at this, on this exact date, with this exact wealth, with this exact spend level. No, but at least the broad strokes of what it is you want to spend in retirement. So that would be the first thing. to think about is just the broad strokes of asset level, spending level, and age when we're going to retire. And then it's the order of operations. There's a lot of value add, I think, that can come out of just saying, okay, when I retire, whether that's roughly going to be 53, 55, 57, whatever, broad strokes, what's the order of operations I'm going to use to access these assets? Do I sell my taxable accounts first? Do I qualify for my military pension at that point? Do I, maybe in the military, it's I retire from the military, but then get another job, which is one retirement, but not a retirement. We could talk about that, but it's essentially coming up with a order of operations. And I will say, we talk about this a lot in the book. We tend to like spending those taxable accounts first. It tends to be a great bridge, a great beginning to retirement from a tax planning perspective.
Okay. Those are really great, I think, advice for people to start thinking about the long term versus the short term. And again, I just think that gets confused a lot when people are thinking of taxes. But I could talk to you about taxes all day long, and that's why this is your third time on the MILMO show. But you'll definitely be back. We'll talk more about it. But I want to switch gears and ask you a couple of quick random questions I ask everybody. And I've asked you 3 times before, so we'll see if yours are different. But what is one resource or tool that you use that makes your life easier or your work?
I haven't thought about this one in a little while. What is something that I use that makes my life easier? Lately, it's been little task checklists. So I go in Google Sheets and I just come up with, all right, by year end, I got to achieve X, Y, and Z. So here's the task. Here's the due date. Here's a little column with done. I got one done today, so I'm feeling good about that. So little checklists, in just Google Sheets, right? It doesn't have to be anything sophisticated, and that helps me keep on track. I'm a financial planner. It's a regulated industry, so there's these little tasks that have to be done from time to time, including paying my own taxes and my firm's taxes and things like that. So little checklists can help make life a little easier.
I love a checklist. That's a good one. What is your favorite book right now or your favorite book of all time? You can't say your books, Sean.
Yeah, all right. Yeah. So,
That's a given. That's a given.
Yeah. So I do, every day I read the Daily Gospel, right? So the Bible would be my favorite book of all time. It's funny. I spent a lot of this year co-writing a book. So that meant I did less reading. I just ordered a book off Amazon. It's a self-published gentleman, and it's a book about the 1971 Houston Astros. And I'm just like, oh, 70s and 80s baseball, like that itches where I scratch. And apparently it's going to come in a couple weeks. I don't know why. There's like some shipping delay or some such. And apparently the 71 Astros didn't do all that great. They won like 79 games. They didn't make the playoffs or anything like that. But I'm like, oh, I can read about some 70s baseball. Like, sign me up for that. So, and it's got a clever title. It's like Orange Crush, the story of the 1971 Houston Astros. So that is on its way to my house, and I'm very much looking forward to getting that. And it's just like a nice diversion. In the year 2025, the world can be a little weighty, and, I'm in personal finance. Even that could be a little weighty. So a little diversion into history about something that's not all that relevant, but fun, 70s and 80s baseball. Why not read that?
Okay. Well, that's a good one. You'll have to tell me the name, and I'll link it up in the show notes for everybody if they're interested as well. All right. Now it is time for my favorite part of the podcast, which is game time. And in honor of your visit today, we're going to be playing good old fact or fiction. So I'm going to give you 5 statements, and you have to tell me if it's a fact or it's fiction. If you get 3 out of 5, Sean, you know the deal. You get bragging rights that you won game time on the MILMO show.
All right. Let's go for it, Lacey.
Okay. Fact or fiction? GPS, Global Positioning System technology, provides a map of any place on Earth. Is that fact or fiction?
Oh, boy, that's tough. I would say, I seem to have some recollection that GPS is banned in certain places, like, for example, potentially some military bases. So I'm going to say that's fiction.
It's fiction, and you get it, but it says GPS technology provides location coordinates. Additionally, technology is required to display that location on a map. So it's coordinates, not the actual map. So you get it.
Oh,
You get it.
okay. Okay.
Okay. Number 2. Wall Street got its name from a wall settlers constructed to keep hogs from running loose on Manhattan. This has been a question before on the show. Is that fact or fiction?
Oh, that's a good one. And
But I feel applicable to personal finance.
absolutely. And yeah, I have this like little bit of a notion. Did they build that wall to keep the water out? But I'm going to say fact.
It's fiction. The wall was built in 1653 by the Dutch to guard against British and Native American attacks.
Interesting.
Now
okay.
you know.
So I'm 1 for 2. Right. So
Yeah.
I'm 50%.
But apparently the National Pork Producers Council says that, but it's not true, according to this game. Okay. Number 3. On the TV show The Brady Bunch, the Brady's dog was named Sam. Is that fact or fiction?
So, all right, I have not watched the Brady Bunch in a while. I think the hook here is that Sam was Alice's on-again, off-again butcher boyfriend. So I'm going to say that is fiction.
That is correct, and that is true. It says that it's her Sam was the butcher who dated Alice, the Brady's maid. Okay, so you got 2 out of the 3 so far. Number 4, a square is a rectangle. Is that fact or fiction?
All right, I got to think about this because one is and I believe that's true. So, because a rectangle, wait a minute. Yeah, because a rectangle is a rectangle is a square, and a lot of squares. So I just wanted to, okay, because this is one of those things
confusing.
where, yeah. All right, so all square. I believe what's true is all squares are rectangles, but not all rectangles are squares. So that means all squares are rectangles. So a square is a rectangle. True.
So you're okay.
Fact.
You are correct, but it says a square must have 4 equal sides. A rectangle can have 2 or more equal sides. Thus, all squares are rectangles, but not all rectangles are squares. That's some random trivia for people. Okay, you have bragging rights, but you have to finish strong, Sean. So we got the last one. John Lennon was the oldest member of the Beatles. Is that fact or fiction?
Oh boy! All right, so 60s music is definitely not my forte. I want to think about that for a second. Paul McCartney's the only survivor, but I don't believe he was the. Oh, that's interesting. Was he the youngest or not? So you're saying John Lennon was the oldest? Is that fact or fiction? Oh boy. Well, actually, is Ringo? No, maybe Ringo Starr did pass. All right, so I'm going to say that's fiction.
That is correct. It says that Ringo was the oldest.
Oh, interesting. Okay.
I do not know if Ringo Starr is still alive, but I am currently Googling it because we all need to know. It looks like he is still alive.
Oh, okay. I apologize to Ringo Starr if he's the. He's just not as he just doesn't. He's not as public facing as Paul McCartney is. Paul McCartney is very public facing. I feel like even to this day, George Harrison did pass though, and maybe I'm just like I'm coming off a cold myself, so it's like I'm coming off my cold, and I'm confusing Ringo Starr and George Harrison.
No, it says though that he is 85. I did not realize.
Wow.
That. Yeah. So I don't know how old Paul McCartney is, but okay. Well, you get bragging rights that you won Game Time. I appreciate you playing and being on the show. Can you tell everybody listening where they can learn more about you and the work you're doing?
Lacey, thanks so much for having me today. It was a real pleasure. You can reach me on my blog, FiTaxGuy.com. I jokingly refer to that as my internet home, and from there you can, find all the places and whatnot. And again, Lacey, really enjoy the conversation. Thanks so much for having me.
Yeah, no, thank you.